Welcome to Trading Nation. I'm Mike Santoli. Fed raising interest rates by a quarter point as expected. Let's get some analysis for what this means for the markets from Scott Wren of the Wells Fargo Investment Institute. Scott, good to see you.
Hey, Mike.
Obviously, this is an expected move by the markets. What do you think it means for the rest of this year? And I guess what really are the markets hinging on for 2019 when it comes to Fed policy?
Well, Mike, I think obviously, there was 100% chance the Fed was going to hike today, and I think really what the market's been paying attention to and is going to continue to pay attention to is pace and magnitude. So for us, we thought we'd see the Fed take a break in December. They probably will not, but I don't think that's the end of the world by any stretch. What the market doesn't want to see is the Fed start to talk about raising rates beyond the 3 hikes that they've suggested in 2019. So I think this was pretty much as expected. I think the Fed, and Jay Powell has verbalized this many, many times. I mean, he knows they've got to be careful in here. If you just look at their GDP expectations, this year they may have raised it a little bit. It's a little higher than where ours is, but next year 2.5 and out in 1.8. I mean, you're not going to get crazy on hiking up interest rates if that's what your GDP outlook is.
All right, well, this latest hike obviously brings the overnight rate to between 2 and 2.25%. If we get another one, you're kind of getting up toward 2.5% for short-term money. Does that feel like normalization? Are we back to normal at that point? And if so, or if we're near it, what does it mean for stock market valuations?
Well, my feeling has been that the where they were going to stop the terminal rate in this was probably about 2.75 to 3. So, they might be a touch higher if they go 3 next year and 1 in December. So, I think that what we're going to see is the stock market, which I consider right now to be at or very close to fair value. I mean, our target, and you and I have talked about this before, for the last year, coming into this year end 2018, has been 2,800 to 2,900. Now, clearly we're trading a bit above the top end of that range. Not a lot, but, we had a 152 earnings estimate out there, and that's probably $5, $6 low, something like that. So I think I could justify, if the market ended somewhere right around here this year, I think that makes some sense. I think the twist here is that the market would probably get an upward move if we had some really good trade negotiation deals, let's say something with China, some kind of a breakthrough. And I also think that what you've been seeing here, and it's been going on institutionally for a little while, you're starting to see some chasing. Our bread and butter is the retail investor. They were sitting on their hands through most of this expansion. But over the course of the last 6 months or so, people are getting more interested. They're starting to put a little bit more money in. And so I think valuations are not cheap. They're not extremely stretched to the upside, but I sense we could be in the early innings, very early innings, of the chasing activity that would typically take you to the top, which, that can play out over a year or two.
And what about to the downside? I mean, what do we have to be looking out for? If you already say, valuations are a bit perhaps above fair, and you have sentiment starting to turn toward a little more enthusiasm, where should we be watching for the hazards here, Scott?
Well, I tell you, Fed language is certainly it, and I don't, the market correctly did not fear a lot of hawkish language out of the statement today. We certainly didn't think that we would see any real hawkish language, but I think for me, going ahead, when if you take a Fed mistake off the table, I think the market is probably most paying attention to what's going on with global growth. And, certainly when you have 35 or 40% of the revenues in the S&P coming from overseas, we need some help from the overseas economies to get to the earnings estimates and the type of targets that we're looking at. So, clearly trade's an issue, but I think really an all-out trade war is a relatively low probability. I'm more worried about, is global growth going to slow down, stabilize? What's going to happen there? So that's my really, if I had to pick one thing, it's global growth.
All right. Well, we did see a bounce in those global markets in the last week or so. Maybe that's telling you that risk is diminished. Scott, thank you very much for joining us. I appreciate it.
Thanks, Mike.
And thank you for checking us out as well. I'm Mike Santoli. This has been Trading Nation.